everyone, welcome back to another episode of Invest in a Moment with MYTHEO. And today, I don't know about you, but I felt like we were living in one big contradiction lately with so many things happening. We're blocking international students, we're raising tariff prices, the rate of inflation is going all over the place. And to make some sense of it, I have a very, very special guest with me today. From the land of the rising sun, I'll let him introduce himself. We have...
Matt Stuart-Box. Hi. Nice to meet you. My name's Matt Stuart-Box. I'm the CIO for MYTHEO and also the CIO for money design in Tokyo. It's lovely to be here.
Cool. So welcome, Matthew. Glad to have you. To kick things off, before we get to this whole segment of what we want to call the abnormal and the new normalcy, right? I want to throw a little icebreaker question. You know, being from Japan and now in Malaysia, I'm sure traveling across the world, what things have you noticed in terms of behaviors, in terms of people, culture shifts? Could be finance, could be food. You know, we love to eat in Malaysia. So what have you noticed?
Yeah, sure. Yeah. So I came from Tokyo. I've been living in Tokyo for the last 20 years or so. And the thing that struck me is it's just the world turned upside down. So Japan traditionally has been the expensive country.
Right.
So no tourists in Japan, basically. And in the last 5 years, it's all exploded. So this year we've got maybe 40 million tourists coming to Japan from all over the place. And that's just such a turnaround from, 10 years ago. And it's great. It's great. This is all these people coming to Japan, seeing Japan for the first time, finding new places that maybe the Japanese people wouldn't think of going to. And it's wonderful, yeah. But it does feel like everything's turned upside down.
What do you think is the main cause of this? Like economic change or behaviors or even different, I guess, cultures as well?
Yep. I think, to be honest, the core of it is economic. Japan's stagnated for a long time economically, whereas, the rest of Asia has gradually been catching up. And now it's reached a point where, it makes sense to go and visit Tokyo, go and visit Kyoto and go and have a look around. So personally, I think it's a great move. It's just kind of leveling everything up.
Okay. Well, hopefully we get into more of that as we deep dive into our topics today. So I guess the topic of today is how we are going to navigate the new unfamiliarity or new normalcy of things happening around the world from an economic perspective, from an investment perspective, and also from, I guess, a finance perspective. Are there new blueprints? Are there new structure changes? Are we entering a place where the previous playbooks all don't work now as innovation and technology come about? And the constant change in financial landscapes.
Yeah, no, I agree. I think we are in a new normal, or some people would call it like a new abnormal even. And things are very different, I think. There's a lot of, on top of the normal kind of cyclical changes that we have in the economy, there's also some really deep structural changes that are going on globally. And I think the impact of some of those changes means that as an investor, some of the assumptions that we've had, some of the things that used to work in the past, perhaps might not work in the future, or at least they might work differently in the future. And so I think it's a very interesting time to be an investor, to be honest, right now.
So let's just dive right in. I want to pick on something you just mentioned where you talked about our current environment as the new abnormal. Maybe for our viewers or listeners right now, can you break that down for us?
Yeah, sure.
And explain that, maybe from an investor's point of view as well.
Yeah, sure. So there's a bunch of things, there's different ways of looking at the new normal. The way we tend to think about it is maybe 3 or 4 different areas. One is the fact that the pandemic has changed a lot of things. Even though the pandemic is gone, everything seems to be back to normal. It's driven a lot of changes in the economy. And the biggest single one probably is the change in the labor force. So we saw during the pandemic, a lot of people actually leave the labor force, just actually stop working completely for a certain period of time. And some of it was voluntarily, some of it was not voluntarily. Then we get up to the end of the pandemic and the restrictions go, and some of those people come back, but a lot of them haven't come back to the labor force. And so we've seen a permanent decrease in the number of workers in many countries. And even when they've come back to the labor force, they haven't come back often as a full-time employee. They've come back as a part-time or a contract worker or something like that. So they've come back in a different format. So the size of the labor force has changed. And then obviously where they're working has changed. So in the US now, 25% of the workforce is working from home at some point in the week. Maybe not every day, but at least some part of time. So that's a huge shift of people who are no longer going into offices, no longer going into work each day, but actually working from home. And so that's a big shift in terms of what it means for real estate, for development and stuff like that. So even though the pandemic is gone, it's actually driven some really deep changes, I think, in the labor market. So that's the first one. The second one is obviously inflation. And, inflation itself is not new. We've always had inflation. It comes and goes and that kind of stuff. But it's a little bit different this time around, and different in two ways. One is the level of inflation is higher than it's been in the past. The kind of natural level of inflation in the economy is higher. So you look at the US pre-pandemic, you were at maybe like 1, maybe 2% inflation per year. Then it spikes up in the pandemic and it's come down, but it's settled at a rate that's maybe 2 or 3% per year. So inflation has fallen back, but it's at a higher natural level than it was in the past. And I think that's a change. And then the second change on inflation is you're seeing inflation where you never used to see it before. And so for me personally, coming from Japan, I've had 20 years in Japan where you never need to worry about prices changing. If anything, prices go down. And then suddenly we're sitting at like 3-4% inflation in Japan. And that's just like certainly for the mindset of Japanese people, that's just a huge change. So we're seeing more persistent inflation, and then we're seeing inflation in places that we never used to see it before. I think those are a couple of big changes, I think, that are going on structurally.
So going back to the labor force, I just want to get your thoughts. How do you feel about working from home?
Yeah. So at Money Design, where I work, we're pretty relaxed. So we work normally 2 days at home, 3 days in the office, but you can vary it. We've got guys there who are working essentially 4 days from home, 1 day in the office. There's a couple of big changes there. One is it's enabled us to move to a much smaller office. So we've been able to save a lot of money simply we realized that we had this lovely office in the center of Tokyo that was half empty all the time. And so a couple of months ago, we moved to a very nice office, but just half the size, and saved us a lot of money. So that's that. But then it also means that the people we can hire no longer actually have to physically be in Tokyo.
Exactly.
And so this kind of opens up the labor market. We've got people working remotely from northern Japan, one guy down in southern Japan, and they come to the office maybe like once a month or something like that. So it's changed, the physical location of the office, but also the people working in the company.
I think to look at it from a holistic or overview of it, there are pros and cons. So what you mentioned in terms of labor force, that's interesting as well, because like you said, people are coming and going out of the labor force that then impacts a business, impacts their revenue and all the things, right? But at the same time, it also just proves that people don't have to be in office. Like I for one think that, hey, if you can work from anywhere and get the job done, the same job as compared to you in office or somewhere else, then by all means, like it doesn't really impact overall. But I do understand that some functions do need people to be in the office. So I guess that is what you just explained with the labor force shifting.
Yeah.
I think people of a younger generation are more likely to be more accommodating to a work from home arrangement than a company maybe 20, 30 years ago would be like, nope, you have to come to office. Oh, we don't see productivity.
Yeah. No, I think that's absolutely right. Yeah. I think there is an age element to it. If I think about the people who come into the office most frequently, it's probably the older people, and the people who value working from home is perhaps the younger people. Yeah, but that's perfectly natural. That's perfectly okay, I think.
So let's then shift this focus to an investment perspective, right? With all these changes, assumptions about different inflation rates, central banks maybe changing policies, growth, how has this shifted, right? Is this now a normal, or what has changed, and how has that impacted everything else as a domino effect? How has that impacted everybody?
Yeah, sure. The way we think about this, there's maybe two really big changes that have happened that really impact us from an investment point of view. One is more to do with kind of globalization. And we've had this for at least 20 years, this kind of steady globalization, companies moving global, this assumption that we were going to be ever more spread out, ever more integrated. And that's all been slammed into reverse, partly by the pandemic, but also partly, to be honest, by actions in the US. And so it's become clear that this kind of trend towards globalization is not inevitable. There's changes to it. And that impacts a lot of companies' business models that were built on this idea of a global supply chain, a global spread out company. That's the first one. But then the second one that's more immediate is just, we don't know what's going to happen now. There's so much uncertainty, especially in terms of policy. In the past, you kind of knew if inflation went up, this is what the governments were likely to do. Or if the trade deficit went down, then this is what governments were likely to do. The fact is, we just don't know anymore what, especially especially in the US, but also in other countries as well. We just don't know how the governments are going to
There's
react.
no real structure anymore.
Yeah, so it seems like everything is up for grabs. There's a whole new layer of uncertainty out there that's beyond the kind of regular investing uncertainty that we're used to. And we've got to get used to managing portfolios in that kind of environment.
So as an investor, how would you, or rather, if you'd advise investors or if you give a note to investors with all these cyclical changes or less so structural changes, it's basically like the Wild Wild West sometimes. And one might feel like that, right? Anything could happen, one might happen. So how would you prepare for it, or rather identify patterns or behaviors or things that may or may not affect the long-term investors?
Yeah, sure. Well, one thing is it's very tempting in this kind of environment to think maybe I should just wait. It's too uncertain. It's too dangerous. It's too scary. Maybe I'll just wait until things calm down and then I'll start investing. And I think that's a very, very dangerous approach. We've seen that when the market rebounds, it rebounds very, very sharply. Even what might look like a relatively small amount of news, you get a big reaction. And so if you're out of the market, if you're out there waiting, it's very, very easy to miss that kind of rebound. I think that's the first thing. Even though it might feel a little uncomfortable at the moment, you've got to stay invested. If you're not invested, then you can't pick up the rebound. I think that's the important thing.
Be comfortable being uncomfortable.
Yeah, and in the long run, you think about it, that's where the return is coming from. You're being rewarded for taking uncertainty. If all of the uncertainty goes away, then there's no return left. You're just left with nothing.
Oh, everyone can do it.
Yeah, exactly. And so I think that's the way you phrase it is exactly right. You've got to become more comfortable with living with uncertainty. That's maybe the biggest one, I think. The second thing is like to think a bit more about what it means to diversify. So in this kind of environment, trying to pick the winners, trying to guess which markets, which assets are going to do well in the next month, the next 6 months, the next 12 months is really, really hard. I mean, it's always hard, but in an environment like this, it's just impossible.
Especially now, so.
Yeah, nobody, I mean, we don't know what he's going to do tomorrow, So in that kind of environment, I think, trying to build a concentrated portfolio with very specific bets on certain markets and things like that is a very dangerous approach. I think right now, more than ever, you've got to be diversified. You've got to spread your risk around because you just don't know what's going to happen. And so you've got to think more seriously about diversifying across different markets, different asset classes, different time horizons to make sure you've got the best chance of picking up the returns.
Okay. Cool. So as we move on to the next topic of conversation, I want to pick again on what you mentioned just now, because I love what you said about investors waiting until you feel safer. Right. When it comes to uncertainty, is this normal? Is this abnormal? Am I waiting too long? Am I waiting too short? Am I patient enough, or do I become then impatient? Maybe in your experience, you can share a bit about how or what do investors really mean when they say they're waiting.
Yeah, sure. Yeah. So we hear this a lot when we talk to our clients, both here in Malaysia and also in Japan. This idea that they're waiting for the right time to invest. And if you watch the news, there's always a reason not to invest, right? There's always something to worry about. And the way I think about it is two things. One is, number one, uncertainty never goes away. There'll always be something there that's uncertain, that's unclear. So if you're waiting for that to clear up, you're going to be waiting forever. Okay, that's the first point. And then the second point goes back to, this idea of where do returns come from? Returns come from bearing uncertainty and being able to switch off, to ignore some of that volatility and look beyond it. It's true there's going to be volatility, certainly, perhaps for the next 4 years, certainly until the end of the presidential term. But for an investor who's looking at a longer horizon, you've just got to be able to look through some of that and be willing to wait and see the returns in the long run.
So from your experience, I'm sure you've seen before, what happens when there are two different kinds of investors, right? I want to say I'm a new investor versus a more experienced long-term investor. Obviously, for a new investor, they might not gauge that, hey, it's FOMO or their trends, or I want to follow whatever people tell me, then that's the cash cow. Whereas a long-term investor will be like, okay, as you mentioned, I know I can wait this out. There is definitely uncertainty in everything I do. And my, data or research tells me that, hey, it's turbulent now, but it will all come out. So when it comes to these two different types of investors, how do you then see the way that they invest, or rather, how does this affect their behaviors?
Yeah, sure. Yeah. So it's very much the case of a new investor or investor who's been around for a while. And where I saw it the most strongly was, at the start of COVID, where everybody panicked. Early 2020, market was going down. Everything seemed to be closing down. It seemed like, in some ways, the end of the world. And it was just a serious environment, and it had serious economic implications. And the markets reflected that, and they fell very sharply. And for an investor who was relatively new to the market, a lot of people sold out. They sold out in February or March 2020, and then they missed this huge rally through the rest of 2020 and most of 2021. So you've got to remember that 2020 was a great year for equities. Like global equities were up, 15, 16% in 2020, and again in the following year. And I don't think anybody really expected that at the start of COVID. But people who've been around, have a little bit more experience, are able to look a little bit further out into the future. We're able to at least just sit tight, not do anything. Obviously, the best thing to do would have been to add to your investments in early 2020. That would have taken a lot of guts. But even just doing nothing, just sitting back and waiting, would mean that by the end of 2020, you'd be sitting on, a 15, 16% return.
Could you share an example of, an example of what was the cost of sitting on sidelines in that time period?
Yeah, sure. So there's a couple of costs. One is obviously the lost opportunity. So you've lost, if you sold it down at the bottom, you've lost probably a 30% rebound in the market. So that's the obvious cost. There's also a cost in terms of trading. When the market is that volatile, it's expensive to trade, and it might not be very visible to you when you're doing it. But if you're trading when the market is falling and you're trying to sell in a falling market, you're going to be pushing down the price even further. You're going to be paying that extra little bit to get hold of the liquidity in a falling market. And so you're losing in two ways. You're losing like the opportunity cost of the rebound, but then the actual trading cost of moving your assets in that kind of market.
And that's when you're certain in uncertainty.
Yes.
I guess that's where the people with, I guess for lack of a word, bigger balls took that leap of faith versus the people who are a bit more sort of conservative and like, you know what, I'll just leave that and then have that for more regret. But again, these are two different types of investors, and I'm sure that you see multiple of them every single time.
Yeah.
Right.
Yeah, that's true.
So having said that, looking at all your different types of investors, I guess different policy changes, different economic factors affecting the market in every single way we never thought would be possible until it happens, right? So going back to a whole, I guess, overview as a investor or as a advisor, or even in finance in general, there is a certain rule book or blueprint or playbook.
Yeah.
How has that changed now compared to maybe 4 or 5 years ago in the pandemic? And is this then something that can be used as a benchmark or can be used as the new rule book?
Yeah, sure. In some senses, things haven't changed in the sense, we're still looking at the expected returns of assets and the risks of assets and how to combine those into a portfolio. So in that sense, the basic rules of investing haven't changed. But I think what has changed, certainly in my mind, is how we should think about risk in a portfolio. The traditional way is to think about, how volatile this price is, how much it goes up, how much it goes down, perhaps how correlated it is, how much it moves with other assets. Those are still valid approaches. But I think what we've seen right now is in certain situations, in panics, in shocks, a lot of those correlations go to one. Everything starts to move in the same direction. And in those kind of environments, what's valuable is the assets that don't move with their correlation, that the assets that stay independent in those kind of incidents. Those kind of assets give you diversification when you really need it. Not just in normal markets where it's nice to have, but it gives you diversification when you need it most. And so for some of our portfolios, we've looked at how to use that definition of risk, not just how it moves in normal markets, but how it's correlated in abnormal markets, and focus our portfolio on that. That's probably a way where you can at least try and limit some of the downside in those kind of shocks, at least give you some kind of buffer in those shocks. So I think changing how you think about risk, how you define risk for a portfolio is probably the biggest single change we've seen for our portfolios.
Well, I want to pick up a few key points as well. You gave a lot of information that I foresee a lot of different conversation topics. But first of all, I want to talk about the diversification, right? So with risk, like you said, the the definition of risk, the very definition of risk to invest now has completely changed.
Yeah.
It's no longer about the returns, it's multiple factors coming together. And when risk changes, does diversification in that definition also change,
Yeah.
do you think?
Yes.
Right? And from that on, with MYTHEO, how does the role of automation or model-driven investing play its role in navigating through all this, not necessarily fixed definitions, but in people's various definitions of the word diversification or risk?
Yeah, sure. So I think it's very true. We've seen recently where the correlation between the equity market and the bond market, traditionally that's been a negative correlation. Equities go down and it's often good for bonds, and vice versa. We've seen recently there's lots of cases where they're positively correlated. Equities go down and they drag bonds with them, or vice versa. And so there's a couple of things you can do to focus on that. One is how you build your equity portfolio and how you build your bond portfolio. So for example, for our bond portfolios, we focus purely on the downside risk. We're not worried about what happens on the upside for those things. They're fixed income, you get a regular coupon from those. We focus purely on the downside in the worst possible case and try and limit that risk. Because the idea is if you can limit how much you lose during a downside, then you've got a much better chance of picking up the upside. And then the other element is the range of assets that you invest in. And so all of our clients in MYTHEO have an allocation to equities, to bonds, and to real assets. And certainly in this kind of environment, this kind of uncertain environment, having some kind of fixed real assets in your portfolio, some exposure to real estate, some exposure to commodities, precious metals, stuff like that, that stuff can be really valuable when equities are going crazy or when bonds are going crazy. So we've found that having that allocation in the MYTHEO portfolio has been really valuable from a diversification point of view.
Okay, cool. For our viewers or listeners who maybe are not so technical in these terms, very good. Give a TLDR or overview of these tools or frameworks that you may personally use or something MYTHEO implements across their range of products, ETFs, bonds, equities, and things like that you previously mentioned.
Yeah, sure. If you think about like how MYTHEO approaches investing, there's maybe two things that are really valuable. One is to do it systematically in an environment where there's a lot of uncertainty, a lot of volatility. It's very easy to make emotional decisions if you're just making the decisions yourself. And the problem with that is in a very volatile environment, humans, they tend to make bad decisions.
You react as you go.
Yeah, exactly. Yeah. So you react to the most recent news, the loudest news, as it were. And it's very easy for somebody in that kind of environment to make a decision that's they're going to regret later on. And so having a systematic approach, all of the portfolios for MYTHEO are built off our own proprietary algorithms, our own proprietary models. And one of the benefits of that is it takes away that kind of emotion when you get to daily trading in your portfolio. Everything is driven by this model, right or wrong, but at least you know that there's a logic behind the portfolio and it's not being driven by your emotions. So that's maybe the first thing. Then the second thing is, in this kind of environment, the costs that you pay to invest are really important. I mentioned like the trading costs earlier on. They can really eat away at your long-term returns. And so for MYTHEO, all of our portfolios are built from ETFs. We don't trade any single stocks, no futures, no derivatives, nothing like that. It's all ETFs. And that means that you get a very diversified portfolio, but you get it very cheaply. It's very easy, even with a relatively small amount of capital, to get a portfolio that's globally diversified across multiple different asset classes. That's very liquid, very cheap to trade, very transparent. I think that's probably the second thing that really helps in the long run, just cutting those costs for your portfolio.
Cool. So I think it really comes down to the different investment behaviors, not reacting, emotionally reacting, but I think we've all been guilty of that at some point. Yes. Emotionally reacting, FOMO, the whole trend with NFTs. That's not easy. So I think what you said is true in terms of, in general, to summarize, there is no set rule book or blueprint, but there is various definitions of risk and investment and diversification criteria.
Yeah.
So Matt, with all these disruptions, all these changes, all these shifts, there is definitely opportunity, as you mentioned before. It's really finding that gap or opportunity, long-term, short-term. And I guess this topic I want to talk about is how you build wealth as part of it. It could be for savings, could be retirement, building wealth over time for the future. So despite everything that's going on, there's definitely still growth, there's innovation. So maybe we can talk now about where investors can focus on. And with MYTHEO, as you mentioned, with your proprietary algorithm and AI, with AI exploding, everybody's in .io right now, right? And if stick AI in your name, sure, let's work something out. But with these climate driving factors, shifts reshaping these industries, how do you see this moving forward?
Sure. Yeah. I think, it's a very good point. I mean, it's very easy to get a little bit depressed about kind of what's going on in the world at the moment. But you're absolutely right. There are hundreds of great opportunities for growth and for investing. And I think, the way to think about it is to try and look beyond these kind of cyclical changes that are going on and pick up on some of the kind of structural things that are going on, because those are things that are going to play out over multiple years and could be really big drivers of returns going forward. So you mentioned AI, and I think that's very true. I think the way we would think about investing with AI is, we use it within our models to a limited extent. But if you think about it from an investment opportunity point of view, the way we'd approach it is the infrastructure of AI is a huge opportunity. When you think of AI queries, things like that, it seems like it's all very intangible. It's all done in the cloud. But the truth is there's a huge physical infrastructure behind all of that. There's huge data centers, there's huge power requirements, huge power generation. Yeah, exactly. That are driven. And all of these are tangible things that need physical assets to build them and stuff like that. And so investing in the kind of companies or the kind of materials that are used in that kind of thing is probably a good way to do it. So within our real assets part of our portfolio, we've got exposure to things like silver, which is used obviously in lots of power generation things, exposure to a whole load of different kind of metals, copper, and a whole load of kind of rare earth metals that are used in various parts of electronics. Exposure to data centers, the infrastructure, power generation, all of those that kind of things are perhaps the most direct and the least risky way to play kind of the AI theme at the moment.
So off topic question, I just want to ask, how has AI impacted your life? Like how on your day-to-day, with the use of AI right now,
Yeah, sure.
there's opportunities and risk. How has that changed you and the way that you view investments or your world in general?
Yeah,
Like,
sure,
how
sure.
is it?
I think a couple of things that have struck me recently is just the speed with which AI has become better than a human. So, for example, in terms of translation, so I live in Japan. A lot of the materials I have to go through is in Japanese. And right now, I plug it into like some AI translator and it'll come up with something that's better than something that I could produce in, like an hour of doing it myself. And it'll do it in like, 2 seconds or something like that. And so that's speeded up my life a huge amount in terms of kind of lowering those barriers, those kind of language barriers between different cultures. That's a wonderful thing if you think about it. It's lowering barriers of communication between people. And we're only starting, I think, to see the benefits that we could get from something like that.
We're still in the very adoption stage. I think very, very early in terms of the capabilities. But having said that, with all these benefits of AI, it all seems exciting, all great and fine that we don't end up in a matrix situation. But what are the red flags amongst all this hype, all this excitement? AI is coming in for this topic in general. AI is coming to change the world. It's going to impact investments in a positive way. It helps us move faster. But what are the risks people tend to overlook, especially when it comes to this sort of investments?
Yeah, sure. What tends to happen when there's a new technology that comes out from an investment point of view is people overreact in the short term. So they over expect in the short term in terms of the changes that will happen. And then they underreact in the long term. And I think we're seeing something similar to this with AI. So we've seen huge expectations, huge valuations on the companies that generate AI models. And I think there is an element of over expectation, an element of hype there. But in terms of the longer term changes, in terms of how it's going to change how we work, how we live, where we live, the kind of work we do, the impact on our health, all of those kind of things, those are going to be much longer term. And I don't think we've even scratched the surface of understanding or pricing what those kind of impacts are going to be.
I guess it all comes down to data as well.
Right.
I guess so you need to have your data. And saying that as an investor right now, for hesitant or non-hesitant investors today, is there a shift in mindset, or how would you explain this shift in mindset to them?
Yeah, this is a very good point. Yeah, so if we think that a lot of things have changed, then it means potentially a lot of data from the past might not be as relevant as it is in the future. I think the biggest mindset shift I think we need to make is to stop focusing on trying to predict returns, predict the future. Obviously, that's always difficult to do, but right now it's especially difficult. Given the structural changes that are going on, given the level of policy uncertainty, trying to pick winners and say, oh yeah, this year I think this country is going to do well, or this asset is going to do well. I think that's the wrong approach. You might be lucky and you might get it right, but if you get it wrong, it could be very painful. So I think the biggest shift that you've got to get away from is not trying to predict the returns, but focus back on the risk, trying to make sure that the risk in your portfolio, in particular the downside risk in your portfolio, is at a level that you're comfortable with, a level at which, if it occurs, you can bear it.
You can take it.
Yeah, because there's no point in investing and then reaching your limit and having to sell out. So I think this shift from focusing on trying to predict individual returns, individual stocks, individual countries, get away from that and think about, okay, how much pain can I live with? Yeah. How much can I endure, and how can I build a portfolio that's going to stay within that range?
It's not as easy as ChatGPT from because you just say, hey, predict me the next stock markets to invest in the next 5 years. No. So that takes us to the end of today's episode. Thank you, Matt, for sharing your insights and your experience. I think we touched on some really key points today. To summarize, what did we learn today? Volatility isn't the enemy. And I think that the world probably won't go back to a normal, rather how to adapt to this new abnormal and move on from there. And definitely waiting for certainty or something more stable might even be the biggest risk for certain investors. So that takes us to the end of today's episode. If you like what you see, don't forget to like, subscribe, listen, follow, share, and maybe share with somebody who you think is too patient in terms of their investments. Until next time, see you guys in the next one.